Coming up, an analysis of governmental responsibility in a financial crisis.
Made possible by the Carnegie Council, the voice for ethics in international affairs.
This week's speaker introduces a moral imperative for governments to intervene in financial markets. Now presenting Roger Farmer.
In writing this book, as has already been eloquently summarized, I had two ends in mind. So one was to provide a lightning description of economic thought for the layperson, and the other was to provide some new ideas. So one of the important themes of the book is that the history of economic thought is an interplay of ideas and events. And economics, for me, is very definitely a science, but it's not an experimental science. It's much more like astronomy. It's a science where we need to learn from natural experiments that are given to us. And in the book, I identify two of such large natural events that occurred in the 20th century, and I believe that the crisis of 2008 is another such event. The events that changed economic and political thought forever in the 20th century were, first of all, the Great Depression, and secondly, a period in the 1970s of high inflation and high unemployment that many of you will remember, stagflation, and in a minute I'll say why they changed economic thought. And the most recent event, the 2008 crisis, just as cataclysmic. Now, the interplay of ideas moved, in my view, between two polar extremes. One I've called classical economics, and classical economists believe very much in the market as a self-stabilizing, self-correcting mechanism, like a piece of clockwork. And left to itself, a market economy will very quickly restore full employment. Now, that idea was prevalent in the 1920s, and there was an important book published by an English economist called Pigou at that time, called Industrial Fluctuations, which nicely summarized the classical view of business cycles at that time. And Pigou identified 6 causes of business fluctuations, and they included things like agricultural fluctuations, monetary disturbances, productivity shocks, tastes, confidence shocks. There was a rich panoply of events that would be driving business cycles. When the stock market crashed in 1929, and by 1933 the market was down 84% and down to a level that it had not been to previously since 1890. And when unemployment went in the United States from 6% to over 24% in the space of 2 years, it became very difficult to maintain that notion that the economy is a smooth, self-regulating mechanism. And many economists, and one in particular, John Maynard Keynes, introduced some new ideas. And Keynes wrote a book in 1936, The General Theory of Employment, Interest and Money, in which he argued that capitalism needed a little help from government to keep functioning. And that really was a turning point, not just for economic thought, but for politics. And the notion that government had a responsibility to maintain full employment was something that was alien before that time, and that was introduced in 1946 with the Employment Act. And since that time, the American economy has functioned much more smoothly. Now, the period from World War II up through the mid-1970s, and in the book I identify 1972 as an important date because that's when an important academic paper was published by one of our Nobel laureates here in America at Chicago, Robert Lucas. At that date, the pendulum swung back to classical ideas. And the reason for that is that the Keynesian policies that had been instituted in 1946 were conditioned on a theory in which the coincidence of inflation and unemployment wasn't possible. So in Keynesian economics, in order to have inflation, you first needed to have the economy functioning at capacity. That clearly wasn't happening in the 1970s, and that was one of the things that led economists to give up, at the time, academic economists at least, to give up on Keynesian economics. The other was that the book itself is extremely difficult to read, internally incoherent, and led to debates amongst academic economists that are still going on today about what Keynes really said. Now, Keynes was first and foremost a pragmatist, and the purpose of writing that book was to persuade economists at the time to move in behind the policies that he thought would be successful. Now, I believe that Keynesian policies were successful, and one of the reasons for that is that if you look at the nature of economic fluctuations after 1946, they're roughly 4 times less volatile than they had been before that date, and specifically during the 19th and early 20th centuries. And there were 2 reasons for that. So the first thing that Keynes advocated was fiscal policies, which were new. So the policy, the fiscal stimulus that's just been introduced by the Obama administration, where we're spending $800 billion that we don't have, that is borrowing, to stimulate the economy, that was a Keynesian policy. So one of the changes in terms of fiscal policy was a big increase in the size of government, and something that I think was relatively successful. That led to a self-stabilizing mechanism in the economy. So government went from 20% at the beginning of World War II to 40% during World War II. I'm sorry, 10% at the beginning of World War II to 40%, came back down to 20%. And one of the reasons that business cycles have been smoother in the post-war period is because government is just less volatile when it spends things. So government expenditure does not go up very much in booms. It doesn't go down very much in recessions, but taxes do. So there's a natural self-stabilizing mechanism put in by having a larger government sector. But that, for me, was not the central part of what happened after World War II. The central part was the development of the institution of central banking, and in particular, the Fed, which had been instituted in 1913, started operating in a new way after World War II. And in particular, they started operating in a way in which they lowered interest rates at the beginning of every recession. I'm often asked if I'm a Keynesian or a classical economist. And the answer I've evolved to that question is I'm a farmerian. And I like to think that what I've done is taken the best of Keynesian and classical ideas. Now, I've already argued that nobody can really agree on what Keynesian ideas are, but for me, there were 2 important ideas in the general theory. The first was that a free market economy could end up with very high unemployment for a very long time if left to itself. And the second is that animal spirits, confidence, Keynes called this animal spirits, is an independent driving force of business cycles. He had a nice analogy when he talked about the stock market. So classical economists think that the stock market is efficient and that the value of stocks just reflects the profit stream that would come when everyone is employed in the economy and it's functioning smoothly. Keynes had a different view about the connection between labor markets and the capital markets. And he argued that the stock market is much more like a beauty contest, but it's a beauty contest in which the judges are judging not how beautiful the contestants are, but how beautiful the other judges think the contestants are. And that, I think, is a really important idea because it reverses the direction of causality between the real economy and the financial markets. Now, I think that those 2 important central ideas in Keynesian economics are basically correct. But I think the way that post-war Keynesians have interpreted them is wrong. If Keynes himself had seen the evidence that I've seen after World War II, that he himself would not be recommending some of the policies that are being put forward in his name. So in my work, I've been working on the notion that confidence is important for a long time. Now, one thing that might surprise or shock you is that the paradigm that we've been teaching to PhD students in the very best institutions in America, in the world, and around the world for the last 30 years, does not contain unemployment in it. And the very notion that it certainly doesn't contain the idea that confidence or animal spirits are important. I've been teaching macroeconomics and researching macroeconomics for 30 years now, and I'm known for my work on self-fulfilling prophecies in macroeconomics. Now, it's long been known, and I've long known, how to incorporate self-fulfilling prophecies or confidence into the classical paradigm. But it took an economic earthquake in the form of the 2008 financial crisis to help us to realize that self-fulfilling financial crises are not a thing of the past, and that they have real effects for the economy. So to go back to my original statement about science and natural experiments, the ideas I put forward have long been accepted, but there are always competing schools of thought in economics, and it's only when we get large events like the 2008 crisis that it's possible to sort out one group of explanations from another. And by 2008, many practicing economists had grown up in the post-1970 period and had forgotten the lessons from the Great Depression, and I think that was a big mistake. What's different in what I'm saying? So let me go back to this notion of the relationship between the financial markets and the real economy. So wealth in the United States consists of roughly 3/5 factories and machines and 2/5 houses. And we own the factories and the machines through our ownership of stocks, through our ownership of pension plans, which indirectly own the stock market and the bonds that are backed up by the companies that own the machines. And we all own houses, or many of us own our own houses. We've all seen the wild swings that occur in the housing market over the last couple of decades. We've all seen the wild swings in the stock market that have occurred in the last couple of decades. Now, when one of those sources of wealth, houses for example, tanks, but the stock market is still high, consumers and investors can still draw on the other source of wealth to keep spending. Demand remains high, and although there may be a recession, it won't be a major one. When the stock market crashes, but houses are still, real estate is still strong, people borrow against their houses and use them as ATM machines, and again, spending keeps going. But when both sources of wealth crash at the same time, as they did in 1929 and as they did in 2008, and when that crash persists for a couple of years, that's when the economy gets into real trouble. Every single recession since World War II was accompanied by a sharp drop in interest rates. That idea that the central bank should drop interest rates and flood the markets with liquidity was a relatively new idea at the beginning of the 20th century. There had been 4 significant financial crises in the 19th century, and as a consequence of those crises, they occurred not just in the United States, but throughout the Western world. A British economist called Walter Bagehot, who was an early editor of The Economist magazine, wrote a wonderful book called Lombard Street, which is literally the book on central banking. And in that, he introduced the idea of a central bank as the lender of last resort. Partly as a consequence of that, the Bank of England evolved into that institution in England, and the Fed was created in 1913. And after 1951, the Fed began learning how to use that tool in order to put liquidity into markets during recessions. Again, in 2008, the interest rate came down to zero, the overnight interest rate, and we were in, at that point, a very difficult situation because the way the Fed had previously stimulated the economy was not open anymore. So why didn't the 2008 crisis turn into the Great Depression? Well, there were two very large responses by federal government. One was the Obama stimulus plan. I may be the only self-professed Keynesian who thinks that that was not a good idea. The other response was from Ben Bernanke, and for me, Ben Bernanke was the white horse here charging in to save the day. And it wasn't only the Fed, but the Bank of England, the European Central Bank, all of these institutions entered into a new, very creative kind of monetary policy called quantitative easing. And what that involved is, traditionally, central banks have held only very safe assets. They've held, in the United States, the Fed has held 3-month Treasury bills on its balance sheet. And the liabilities side of the Fed is the money supply. Now, it wasn't possible to lower the interest rate on overnight loans, but Bernanke, being a student of the Great Depression, recognized that there were other kinds of ways of getting money flowing in the economy, and he bought the assets of Freddie Mac and Fannie Mae, mortgage-backed securities, and that is largely responsible for the fact that long-term interest mortgage rates are now lower than they've ever been historically. And secondly, he bought long-term government debt, and that is responsible, in my view, for the 70% appreciation in the stock market that we've seen in the last year and a half. And as wealth has slowly started to recover, so consumption did not fall as much as it might have done, investment is now beginning to flow back into the economy, and very slowly, employment is beginning to turn around. So, what am I advocating? I'd like to see much more, a large extension of policies much like the quantitative easing policy. The notion that the Federal Reserve should control the interest rate when it was first floated in the early 20th century was a very radical notion. And the notion that government should be controlling a price. But now it's accepted, and it turns out to have been a very successful policy. What I'd like to see is a policy in which the Federal Reserve controls not one price, but two. And the second price that I think is important would be an index fund from the stock market. So the proposal is to put together an index like, say, the Russell, whatever it is, the bit broader than the S&P, something that would have every publicly traded stock in which the weights of the companies within that index were value weighted. So if a company became less valuable, it would fall in weight in the index. And then I would have the Fed step in to put a floor and a ceiling on the rate at which that index could grow. Now, if you look at the markets today, there's something like 1.2 trillion in excess reserves sitting in the banking system. I think that the markets are probably fairly valued right now, but that excess liquidity is sitting there because many investors believe, and rightly so, that there's still quite a lot of downside risk. They believe that although we're recovering, that recovery is very fragile and markets could fall again. In order to get that money moving out and into the real economy and buying real goods, investing in factories, getting jobs back, we need to restore confidence and let people know, and one way to do that is to let people know that that kind of fall would not be permitted. So my policy going forward would be really an extension of the quantitative easing policy, an extension in the sense that what quantitative easing represented was a decision to purchase long-term assets rather than just short-term assets. I'd like to see that done more carefully, and I think that's a good point to throw open questions.
I am fascinated by the idea of the expansion of quantitative easing. I think it's elegant in many ways. If this index and Fed regime had been in place in, shall we say, 1996, I don't know if you have any sense around how much selling might have been done to contain Mr. Greenspan's what was it, irrational exuberance, if there's any sense around how much, and if you envision naked shorts on the part of the Fed and any implications off of that.
Let's think about how the scheme would work. The balance sheet of the Fed just before the current crisis was roughly $800 billion, and that's the money supply. I would have had the Fed purchase, so the first step would be to define what's in the fund, in the index fund. It might contain bonds. The most important thing is it's very, very broad. The other thing is that the weights of companies within the fund are determined by the market and not by the Fed. So I'm not having the Fed here come in and decide left and right shoes. The second thing is I'd have the Fed purchase a block of shares in this fund, say another $800 billion. Now, how do you do that without increasing the money supply? And I don't want to do that. I'm not advocating monetary expansion here. So I would give the Fed authority either to issue its own debt or, and they already have this authority, I would have it pay interest on reserves. And I would have it pay interest on reserves at the same rate as 3-month T-bills, so they become essentially equivalent. So now we've insulated the money supply from any intervention we have into the markets. Now, the question was what would have happened in 1996. It's very easy to see what would happen on the downside. So if markets were falling, the Fed would potentially step in and buy the index fund. And the very fact that it's plausible that the Fed could step in and buy the index fund in itself, I believe, would mean that it would never have to do it. And if you take the worst case scenario, the worst case scenario is I said factories and machines were 3/5 of wealth, actually 3 times GDP. So the Fed would buy the entire market. Now, federal debt would then be 3 times GDP, but the Fed would own the entire market, and the dividends flowing into the Fed from profits from American corporations would fund the payment of the interest on the debt. So the first thing is that's a wash. In fact, the Fed would probably make a profit on that transaction. But what about the upside? So we're now in 1996. There's a huge bubble going on, and the Fed had $800 billion hypothetically in index funds that it had bought. It sells them all. Now it's run out. What's it going to do? Well, it creates synthetic index funds, just as we've had synthetic derivatives in the last 10 years, and it sells them on the market. And these synthetic index funds pay exactly the same return that you would get if you were buying the market. And by flooding the market with these things, they prick the bubble. The important point here is that they do it without affecting short-term interest rates. So I'm not advocating pricking bubbles by raising rates. And the reason I'm not advocating that is precisely because of my view about confidence in markets. I think if Greenspan had done that in the 1990s, he's absolutely right. It would have deflated the bubble, and the helium balloon would have crashed. So it's necessary to have this other instrument to prevent precisely that from occurring.
When an unelected official, essentially, is intervening in the market and therefore affecting the value of stocks, people are going to understand, or I think the financial press and the commentators are going to be able to make a much closer link than they will with interest rates. I think that will be much more understandable by the average person. And whether, therefore, that is really setting up an institution or powers for an institution that's going to be politically acceptable.
The political question is a very important question. I would say that the institution that I would foresee implementing that, I would give additional authority, and I know this is not a good time to be saying this, I would give additional authority to the Fed Open Market Committee, because I think the coordination of interest rate policy and the new policy that I'm suggesting would be essential. It wouldn't be possible. You really do not want one committee off doing one thing and another one doing something else. Now, it's already, the Fed Open Market Committee already has immense political power. It's often stated that Bernanke is the second most powerful man in the world, and there's a sense in which that's true. I don't see any alternative to developing an institution like that, which is indeed in a non-elected official, I don't see an alternative, to put it that way. Now, whether or not, I don't expect that the kind of proposal I'm putting would not be an easy one to get through the political system. In fact, it may well take a double-dip recession and much higher unemployment in order to get us there.
Well, unfortunately, we've run out of time, but it was just a stimulating discussion, and I thank you so much.
We hope this program has been informative and has provided some perspective on the underlying ethical issues.
Made possible by the Carnegie Council, the voice for ethics in international affairs. For more information, see www